The freer a financial intermediary is, the more it is likely to offer a higher return, and therefore the more people are, in good times, are likely to want to go there. There are many people, and very able and very intelligent people, who believe that the regulation of banks is self-defeating, because they will always find a way around it.
There are rules about what banks can and can't do with our money. As a result, a whole host of other institutions, such as hedge funds, money market funds, and off-balance sheet vehicles have emerged, which behave like banks, but because they don't call themselves banks, face much less regulation. This largely unregulated activity is called shadow banking.
In order to be able to call yourself a bank, you need to have a banking license. To be a shadow bank, it's very simple because you can provide the same sort of functions that a bank does, only you just don't need to go get the license. Now, the downside of that is that you can't then market yourself as a bank to the general public, but of course, a lot of these institutions have absolutely no interest in doing that anyway.
Banks traditionally have used shadow banking extensively to get around the rules. Many of them ran internal hedge funds and internal private equity funds that did bank-like things without being a bank. If banking were cheap and easy to do and unregulated, there would be no shadow banking. Banking is expensive, banking is problematic, banking is highly regulated. So shadow banking exists to get out of that spotlight and get out of that focus.
The danger in having sort of two separate terms, shadow banking and traditional banking, is that it gives the impression that shadow banking is wholly separate from traditional banking. This is just completely not correct. There are huge connections between traditional banks and shadow banks, and what's interesting about that is if you actually took steps to limit the amount of exposure that traditional banks and shadow banks could have, then you'd have two effects. You'd make the financial system more stable, and you may actually find a significant percentage of shadow banking disappears altogether.
Frankly, if a shadow bank goes bust, we don't really care that much. It will hurt people, but it won't take down the financial system. Each individual little bit of shadow banking is not very big and doesn't look very important. It's when a whole group of things combine to make a mess, or all of them move in a herd instinct, that they're a problem.
Problems in the shadow banking system actually hugely exacerbated the fallout from the collapse of Lehman Brothers. Money market fund lost a lot of money. It was actually one of a very few number of money market funds that have ever lost money, because these funds are perceived essentially to be risk-free, even though theoretically they're not. The problem was when this fund declared its losses, this then spooked all the investors who'd had believed that essentially their money was completely safe, and this led to a run effectively on the shadow banking sector.
There's actually more banking type stuff going on in the shadow banking world than there is in banks. At the height of the financial boom right before the crisis, shadow banking was larger than banking by a significant margin. It then dropped to being close to banking, and now it's back up to almost pre-crisis levels, which means it is again larger than banking. There's this giant unregulated world out there that is doing stuff that we don't even know what it is.
Several of the main problems in the crisis, 2007-2008, occurred because not very good loans for housing and commercial property were hidden off the bank's own balance sheets in shadow banking format. And when they went wrong, the banks actually had to take them back onto their own balance sheet, if only for reputational purposes.
Banks know what their job is, and they screwed it up. Shadow banks were always sort of on their own doing wacky things, and there it's much less intentional. Each individual little piece didn't think they were doing anything wrong, but when you added it all together, it was terrible.
Perhaps the most celebrated kind of shadow bank is the hedge fund, a pool of money which skilled traders invest in public markets. Sometimes staffed by as little as 2 or 3 individuals, many of these obscure organizations spend the day pushing billions of dollars around the world. Because most of what hedge funds do was either banned or heavily restricted after the Wall Street crash in the 1920s, they're not allowed to advertise their services to the public at large. And walking around London's Mayfair, whose streets are peppered with hedge fund offices, you'd be hard-pressed to spot even a nameplate on a doorbell.
There are very strict limitations on who can put their money in. So for example, they're very often invitation only, and the sorts of people who put their money in are high net worth individuals and often investment banks. Because these are so-called sophisticated investors rather than the general public, these funds can then go out and do very kind of risky, exotic, highly structured trading strategies, which theoretically will reap enormously high returns.
It doesn't always take a group of hedge funds to bring down the financial system. Sometimes one is all it takes. In the mid-90s, a team of Nobel Prize-winning economists set up a fund called Long-Term Capital Management from an office in Greenwich, Connecticut. Within 5 years, this enormous institution had rocked the financial world to its core.
Long-term capital management was a very famous, extremely large hedge fund that was founded by some very senior traders from a large investment bank. Everyone had the idea that this fund would be absolutely infallible and would make spectacular returns, and so all investment banks wanted to have a piece of this institution. Of course, things didn't work out as planned and it collapsed.
Clearly LTCM was such a huge hedge fund and had such a dominant position in a limited number of markets that it was felt that if that was allowed to go, there would be problems.
New York Federal Reserve had to essentially mediate a bailout, so they had to get all the investment banks around a table and they all had to agree to put in money to bail this hedge fund out. This was the first sort of alarm bells indication that shadow banks do actually have the capacity to bring down the entire financial system.
In the near future, due to incoming regulations, every time a bank trades with any other institution, a clearinghouse will sit in the middle, asking for the two parties to post it collateral that can be claimed if one of the trading partners goes bust before the trade is over. A clearinghouse will value a financial trade every day and make appropriate collateral demands on the basis of this valuation. If one of the partners goes bust, the clearinghouse is then liable to reimburse the other partner for the value of the now defunct trade.
There is a serious concern at the moment that clearinghouses are too big to fail because all the transactions of all standardized products, including most derivatives, are now being put through clearinghouses. And if the clearinghouse itself should fail, then the effect on all the intermediaries who work through and with the clearinghouse could be devastating.
The clearinghouse is now where all the risk is. So if the clearinghouse goes down, it takes the whole